I hope you can see the webinar that I'm sharing. Accounts Management Course Webinar 2. I'm Mrs. Caserera. I'm going to take you through. I introduced myself from the last webinar that we had. And for those who were not there, I'm a registered accountant. I'm a chartered accountant and a registered auditor. And I assist with facilitation of this course from year to year, and as well as with these webinars that we are having. Okay, for any admin matters, any technical issues, may you contact Grace. Grace will be able to assist you. And if you have any issues, please feel free to contact her. So it can be when you are sick, when you can't submit your assignment, late for any reason. So please contact her so that she can give me instructions on what to do. Okay, you know, these lectures, they are from the Law Society of South Africa. So I get instructions from there on what to do when you cannot submit. Okay. And for the benefit of other students, please ask the questions on the forum. Then we will answer there. If ever we're not on webinars, please ask there so that everyone can benefit. They don't have to repeat the same questions. Okay. And then webinar 2, that's where we are. We are going to cover trust investments. We're going to cover correspondent transactions, conveyancing transactions, VAT, and other taxes. Then we'll be done with our module. So the way that we have done webinar 2, we've split it into 2 because when we are working on the assignment, it's quite tedious and long. So today I'll cover more of the theory, and then we get into the practical example so that when you start with your assignment, then you can already have a starting point. So, but the starting point was our webinar 1, where we had to work on a cash book. So that cash book still, those cash books still, they are needed for our assignment 2. Okay. Happiness. Okay, so let's get into trust investments. Okay, so remember we want to hash you back. Remember, we have said that our trust account is according to section 86.1, section 86.2. Sorry for that, section 86.2, because section 86.1, it's just a requirement for every legal practitioner who wants to operate a trust account to keep a trust account. And then when it goes to section 86.2 of the Legal Practice Act, then it stipulates that a trust account is to be opened by any bank which is registered by the Banking Act. And that trust account should have reference to section 86.2. And we have agreed and also have indicated that you can open as much trust accounts as needed as long as you notify the LPC that you have opened a trust account, and also you submit them for audit. Remember the in-care bank charges. So if the in-care bank charges and bank charges are higher than interest, then the firm or the practice is responsible for paying the bank charges. Okay, so with our investments account, we've got what we call a section 83 and a section 84 according to the Act. So with a section 86.3, what transpires is that the fund is allowed, it has always been in existence. So they've allowed such that if you see as the practitioner that you've got too much funds in your trust account, and some of them, they are not needed immediately. So what you can do is that at your discretion, you can open a call account that is according to section 86.3. So the bank, you instruct them that is the section 86.3, and then you reserve those funds in that account just for safekeeping. The thing is that the interest that is earned there is usually almost the same as the interest rate as the trust account, and 100% of the interest is payable to the fund. So usually you do it to avoid fraud, because you can hide this particular account, you can actually hide it. And when you hide it, then it comes to your advantage, because whenever anything you are intercepted, that account won't be able to be accessible. Okay, so the fund recommends that you invest money in according to Section 86.3. Okay, and then we've got Section 86.4. Section 86.4, these are investments on behalf of clients. So we get instructions from our clients. And the thing is that you as a professional, you've got a duty to advise your client to say, okay, that's money that you are giving me, you can invest it. Okay, and then you can invest it according to Section, not you can, we can invest it on your behalf in terms of Section 86.4, and the interest that is earned in such an account, 95% is payable to you as the client, and then 5% is payable to the fund. Okay, so it is you who can advise clients, or those clients that are aware when they give money for an underlying transaction that is going to take long, then they would instruct to say, may you open. And I've seen the practice is allowed to then charge a small fee or percentage to cover any administration cost that that can arise from opening such an account. Okay, so that's a Section 86.4. And the thing that happens with the Section 86.4, you find the money has to be paid. It has got rules. So part of the rules are that money has to be paid into the trust account. And then the second rule is that it has to be under the control of the firm or the practice or the practitioner or the directors. The client cannot control such funds, and the funds can only be invested in banks which are registered according to the Banking Act. So you cannot just invest in a call account. You cannot just invest in any other ways like money market accounts or unit trusts, or that you can't do. So you have to do it according to Section 86.4. The advantage of Section 86.2, 3, and 4 is that these funds are protected by the Fidelity Fund. So the interest that we pay over to the Fidelity Fund is there to safeguard these trust accounts. So if ever there's any misappropriation that can happen, which is not encouraged, then the fund, as a fund of last resort, can refund. It can, if the client applies and is exhausted all the means that are available, the fund can then refund. They can pay partly or fully the amount that was initially paid into these accounts. Okay. And the other thing for Section 86.4, the money has to come back into trust, and then from the trust, then paid to the client account, paid to the client. And then the 5% interest payable, usually, if the account is properly opened, it is automatically paid to the Fidelity Fund by the bank. Okay, especially FNB, I know they do that. The other upside, I think if you can just open it properly, then the banks will do that for you. Okay. And then there are those investments that say a client just comes and say, I've got so much money, can you invest? The firm or the practice goes ahead, figures the client, feels safe and secure that this is not for money laundering, then they accept the money, and then they can be given instructions by the client on what to do with the money, and then they invest according to the client's instructions without having any underlying transaction, unlike a Section 86.4 where there is an underlying transaction. Morning. Say
good afternoon.
Hello. 86.4, so there's an underlying transaction. It can be a conveyancing matter. It can be, say, third-party matter, usually with the Road Accident Fund. The court would order that while the firm is waiting for a trust to be opened, the money should be kept in a Section 86.4. Okay, so then we invest according to such instructions. All right, and then for the investment practice, for it to be called a practice, so there's no underlying transaction, the mandate is from the client, and if the firm can handle more than 10 transactions, then it is then an investment practice. And when completing your audit report, then one has to indicate that they are operating in investment practice, and also they have to follow the accounting rules according to section 55.1. And also the Act, I think it has got a section that guides the investment practice. So the auditors will then check and ensure that there's compliance in terms of the accounting records and everything that is required. Okay. So I've indicated the fund covers trust account, section 83, 863, 864, against misappropriation. Okay, so those are our trust investments. So we'll do an example where we are going to invest in a section 864 and then how that money, the transactions are recorded. Okay, so let's move on to corresponding transactions. Okay, and this one, it relates to those transactions that come from our business partners. Say we have other firms in other regions that we cannot conduct business in our jurisdiction. Then those firms can instruct our firm. They can instruct our firm to carry out their duties for them, to perform their services for them. And when we perform those services, then we are entitled to fees and we can share the fees accordingly. So those firms, then we call them our correspondence firms that we are dealing with, or correspondence practices, just because of issues of jurisdiction. Okay, and even from our end as a practice, we can instruct, say for instance, you can instruct another firm to finalize or to carry out a mandate on behalf of our client who is in another jurisdiction. So we instruct them, and then they also are entitled to fees and also to share with us the fees. Okay, so usually there's an agreed 1/3 fee allowance that is agreeable. So the instructing firm that is not doing much of the work would receive 1/3, or it can be a fee that is less than 1/3 as per agreement, but the maximum, I guess, is 1/3. Okay, so say for instance, I give instructions and I agree that on my instructions I'll retain, or you pay me 20% and you can retain 80%. So once the fees, the practices agree, then they will do the service of the file, and then after that they share the fees. Okay, so in these transactions there is what we call VAT implications. If the firms are registered for VAT, then the VAT, the 1/3 will go with its fair share of the VAT, so that the accounting of such fees is done to SARS by the receiving entity, and the remaining entity will remain with its own 2/3 share of the VAT, so that they can also account for their fees accordingly to SARS. Okay. So for examples, we normally use collection matters as an example of correspondence, but it can be anything that can be done by the firm. So if a firm is given a litigation matter, yes, they can carry out a litigation, and it's the issues of sharing fees, and then we show how that is done. Okay. So if you look at it, it means both firms will record the transactions differently. Okay, so if it's the entity that is being instructed, it is going to collect the money from the client in full, you see, and it is going to record the transaction that is happening between it and the correspondent against the correspondent attorneys, not against the client or the person from whom they are collecting. Okay, and when it comes to fees, then they are receiving the 100% of what is being collected, and they are paying over after deducting their fee, which means the receiving the instructing firm is going to receive less, and when they're accounting, they account for less. But on their statement of accounts, obviously, for the sake of their clients, then they would show the actual collection was for the full amount, which is so much, and the fees which were collected by the correspondent attorneys were so much, and this is what is left for the client, this is what is left for us. Okay, so the accounting is what, the way that they record is a bit different. Okay, so we'll do an example, a collection matter, and then with that collection matter, we'll be able to apply the principles of a correspondent. Okay, and then the other one, it's a conveyancing matter. Conveyancing matters that we are going to have a look at, and in your assignment there is also a conveyancing matter. Okay, for those like the advocates, I know you don't deal with conveyancing, but it's it is another avenue of law where I would say specialized, they call it specialized, but it is mainly for registration of immovable property. So immovable property can only be registered using attorneys or using conveyancers. And then with these conveyancers, they are registered as such, or you can instruct a firm that is not registered, and then they look for a correspondent conveyancer who would then carry out the service, and then they share the fees. Okay, so with these conveyancing instructions, usually they are referred to the conveyancers by the sellers or the estate agents. Okay, remember the estate agents, they are acting on behalf of sellers. They act on behalf of sellers, and they are given instructions by sellers. So if a seller tells them to look for a conveyancer, then they look for a firm that they give their matters to. And then those firms, then they handle the matter. So most estate agents, you find they nowadays they are now called property practitioners. So these property practitioners, according to their new act, you find they can have trust accounts. They can have trust accounts, but they rarely utilize them. So they do not prefer, they would rather than pass the matter in full to the conveyancer, who is going to then carry out the matter, follow instructions, draw documents, and do the lodgements, and then thereafter distribute the funds to the seller, estate agent, and to the purchaser if ever there is anything. Okay, so what the conveyancer would do after receiving the offer to purchase for a property, they notify this purchaser that, okay, your seller is instructed that us, or the estate agent has instructed us, and we're going to start withdrawing the documents, and then we'll call you to come and sign. So they would come and sign for things like FICA purposes, draw documents for FICA as required by the Act. Ensure that they FICA the client and check the sources of income and any other information required. And from there, they also draw documents pertaining to the property, okay? The property like the transfer duty, and also the bond attorneys, they come into play. But in our case, because it's another firm of attorneys, their transactions are not part of our transactions. We just account for the conveyancing firm. We are not accounting for the bond firm. But the concept is the same of double entry, whether you are given a bond registration firm or a conveyancing transfer firm, then the transactions are not difficult to record. Okay, so after drawing the documents, they make sure that they collect the guarantees from the bond attorneys, and they receive the payments. So it will be if ever there's a deposit for the property, then they stipulate the period, then they make sure they receive the payment, and also they receive payment for rates and taxes clearance, levies clearance, and from the side of the purchaser, if ever there's any transfer duty that is payable, then they also receive the money for transfer duty. And for the purchaser as well, for the transfer fees, they are paid for the for by the purchaser and any other disbursements that are payable, like the deeds fees, they are payable by the purchaser. So they make sure that they receive the money and they've received also their money in advance. Okay. And then from there, the conveyancers, they ensure that they then complete the duty documents and pay and receive the transfer duty receipt. And also they facilitate to ensure that they receive clearance certificates for rates and for levies if the property is in an estate. Okay, and then these documents, once everything is there, and the bond attorneys, if ever they are bond attorneys, if it's not a cash deal, if it's a cash deal, then it means then they will be ready to lodge after everyone is signed, everything is in place, ready to lodge. Then they go to the deeds office, then they lodge, and then after a week or two, then you are told the property has been registered. And once it is registered, they've got 48 hours in which they have to collect the money and pay the seller, pay the purchaser if ever there's anything refundable, and also pay the estate agents. And then they can take their fees. So we'd say they've performed a service and they can raise an invoice and bill for their fees. Okay, so that's basically conveyancing in a nutshell. Not so complicated, but I heard the exams are quite tedious and hard. Okay. And then the last topic that we have is on taxes. Okay, taxes. So in this case, I think I've just put it through as VAT, but VAT is not the only tax. But I will then discuss the other taxes which are not on the slide. So let's start with the VAT. Okay, value-added tax is levied according to the Value-Added Tax Act. So if you can Google it, you'll be able to download the Act. And if you can go through the Act will stipulate when a practice or a company or a business can register for VAT. Okay, so the things that they look at is that one should be supplying goods or services, and then that supply of goods and services should be continuous. It should not be a once-off thing. And when it is continuous, then there should be a threshold. So if a practice can sell, if a company can sell its goods for more than 1 million, or a practice can bill for its services, can invoice for more than 1 million in a given 12 months period, then statutorily they're supposed to register for value-added tax, which I'm going to refer as VAT or VAT, yes. Okay. And the Act, it will give exemptions if ever there are any. They then give exemptions which companies are not supposed to register for tax, and which ones are supposed to register for standard tax. Okay, so we have the VAT rate. In our case, the VAT rate here in South Africa, it's 15%, and previously it was on 14% until April 2018, April 2008. That's when the rate was changed to 15%. So it has remained on 15% for some years now. Okay, and VAT, this tax is collection for government. Remember, any tax, it's for collection for government, and it's called an indirect tax. Why it is an indirect tax is that it is levied in goods or services. Okay, so if you want to procure something from a VAT vendor, some business that is registered or a person that is registered, that's where then you would find you are levied this tax. Okay, and sometimes they don't even tell you, but the goods, if you then check the invoice, then they're inclusive of it. So if you walk into the supermarkets, they don't even show in their pricing to say this brand, which is going for 15.99, the VAT is so much. It is well known that then if it is VATable, then the VAT is inclusive. Okay, so it is like the businesses here, they are told to give clients, they're told to give customers prices which are inclusive of VAT, so that a person does not have to worry about recomputing or computing, or you are satisfied with the price, then you pay, you are done, that's it. And then the business is the one that has to then separate between their fee and the VAT component. Okay. Okay, and then the standard rated goods. So these are all the other goods which are goods and services which are not specifically categorized under zero rated and exempt goods and supplies. They should be standard rated. So any service, anything that gives you an income, anything that gives you an income that is not exempt, that is not zero rated, should be charged VAT. As long as you're in a business, you can't tell your client, I'll exempt you. You can't exempt. This is a statutory requirement. Once you are a VAT vendor, once your business is a VAT vendor, VAT has to be charged. Okay, at a standard rate. Okay, and for zero rated goods, so you can go Google, check zero rated goods. For example, we've got diesel, we've got petrol, we've got bread, we've got some vegetables, we've got some basics which are zero rated. So you just kind of like need to know what is what. Okay, and from there we've got what we call exempt goods. So with the exempt goods, the Act stipulates that this is exempt from charging VAT. Services like your education is exempt. So you find those businesses that are under the education sector, they don't even register for VAT because they cannot charge their students VAT, or they cannot collect VAT whenever they purchase. So they are exempt and they cannot claim VAT. Okay, but those which are zero rated can claim VAT. So if they buy from a vendor that is VAT registered to supplement or to augment, to carry out their enterprise, then they have to register for, they have to claim, they can claim that. So you can be zero rated, like suppliers of fuel, they are zero rated, but you find they register for VAT so that they can claim on the input when they are buying, say, for repairs and maintenance, telephones, those things that are allowable. Okay. Happiness, and then the exempt goods and supplies, the indicated education, and then there's some housing by the department, not every other house. And there's like rent should be exempt or should be zero rated. I can't remember, like the residential rent, not the commercial one. So it's exempt. So you just need to check which one is which. Okay. And for imports and exports, then you also need to check the imports, they are charged VAT. So you are bringing goods into the country. Consumption is going to be in the country. Then they are charged VAT at the point of entry. Okay, and exports, because those goods are not going to be consumed in the country, then the VAT is not charged. So you just need to prove that you have exported these goods. Otherwise, if you sell to a client here who is going to export, that client will have to claim their VAT at the borders, their VAT offices where you can claim for refunds, or you can come back at the airports and then you claim the VAT. Okay, so the other thing that I did not clearly mention, VAT is a consumption VAT. It's targeted at the consumer, the final consumer. So at every stage of production, remember we mark up, we put a markup, and then you find the VAT then increases. Then at that stage, whoever buys at that stage pays VAT, and then that one who bought at the previous stage claims from the one that he paid. So the net effect is the one that is going to SARS. And then when it comes to, until it reaches the final consumer, who then pays the full price and cannot claim from anyone. Okay, so the consumer is the diehard, he has to pay and no one or make him claim. Okay, so it's a consumption. So where consumption, if consumption is within South Africa, then VAT has to be charged. As long as it falls under the standard rate, then VAT has to be charged. Consumption out of South Africa, then no VAT. And same applies. You find other countries, that's what they do. They will always refund you for your VAT because you are not going to enjoy the consumption in their country. Okay, let's move on. And then the terminology for VAT, we've got what they call VAT periods. So with the VAT periods, there are, I think, basically 3 periods. There's period 1, which is period A. So that category is for those businesses that have to submit, I think it's even months, where January and February, the 2 months bi-monthly. Remember, we have to submit every bi-monthly. So for those 2 periods, they make sure that they submit the return in the following period, and then they pay in the following period, which is March. So if they do not pay in March, then they are penalized. Okay, March and April, you pay in May, and then if you do not pay in May, you get penalized. Like that. And then the category B is the one that is for odd months, which is like your December and January, February and March. So December and January, your return, you submit it in February. February and March, your return, you submit it in April. April and May, just like that. So you submit, you pay, you submit, you pay. If you do not submit and pay, then there are penalties. SARS is always there to follow up on that, and it becomes tedious when they follow up. Okay, and then the other terminology that we have, it's the payment, whether the way that we account, that we account for VAT. Okay, so for individuals, like if you're running a practice under your name, sole practice, and you have exceeded that 1 million mark, and you have not exceeded the 2.5 million mark, then you can account on a payment basis. This is like when money is being received. That's what, when you account. When you pay out invoices, we can account for them then. Okay, so you are given a leeway. Whenever you receive money, you pay for your VAT. Whenever you receive money, you can pay for your VAT. Unlike when it's a company, any juristic person, which is not an individual, they have to account on an invoice basis, accrual system, accounting system, and it's called an invoice basis. So with the invoice basis, whenever you issue an invoice, that's when you account for your VAT, whether you've been paid or not paid. That is your own issue. With SARS, they just want their money on an invoice. So they are more of like encouraging you to have good payment terms with your clients so that they pay you in time and you are able to pay over to SARS. Okay, so with that method, if you can look at it, then the disadvantage is that it can have timing differences and can result in problems like cash flow problems. Because say, for instance, you give an invoice to the government and they pay you after 6 months, and SARS will require you to pay VAT in the following month, you see? And then that gap, you'll be financing invoices and financing SARS without having any income coming your way. By the time that income comes, then probably then we say you start to be liquid. Okay, that is the accounting or invoice basis. Okay. And then the other thing that we have, how we compute the VAT, we've got what we call VAT output. So the output is coming from what we are taking out. So we offer the final service, we put in an invoice, it's out of our invoice, our fee plus VAT, then that is called output VAT. Fee plus VAT, so that VAT is output VAT. Okay, and then input VAT is on the procurement, what we have bought, what we have paid. So that is where the input is coming from, like the where we've spent energy on what we've put in creating the output, then that is your input. So in your input, you remember it's VAT, it's invoice based, only from from VAT vendors. Anything that you pay to a VAT vendor that is allowable, then you can claim it. If a person, like salaries, our employees are not VAT vendors, so we cannot claim anything from them. If we draw money, they are not VAT vendors. We cannot claim any VAT on that. So you have to hold an invoice from a VAT vendor for you to be able to claim input VAT. The difference between output and input VAT, it can give you a net amount of what is payable to SARS, or it can give you a situation where the input is higher than the output. Then you can get a refund. Obviously, with a refund, you will have to fight with SARS because they will make you to prove that you have a refund. And for you to be able to prove, you need to have your invoices in place. You need to have your invoices in place. And with those invoices in place, you will need to make sure that your invoices are valid. So the Act stipulates to say what is a valid invoice. It has to be a tax invoice, should have the supplier's name, contact details, address, the VAT number. And also on the other side, it should have the customer's name, address, contact numbers, as well as the VAT number. And in the description of the services, it should be clear what is it that was supplied. So if it's legal services, then one would say, this is what we did, attended court, time spent is 1, 2, 3, 4, 5, did 1, 2, 3, time spent is 4, 5, 6, 7. So that's how you make sure that your invoice is valid. When you submit it to SARS, then they are going to accept it. Otherwise, they reject it. And the other thing is that with SARS, they can conduct audits. They can decide to conduct audits, say 3 months later. So one, you just have to make sure that you in those 3 years, you have kept those invoices and you can prove that you bought or you supplied. If you can't, the onus rests on you as the business owner. Okay, and remember with VAT, it is the initiation of VAT comes from the business owner, the practice. So the practice will have to ensure that they compute, they know their periods, they submit, they make payment. Then it is up to SARS whether they want to review that VAT return or they want to audit. If ever they want to audit, they will call for an audit officially, and then you update to that. So the initiative is from you to ensure that there's compliance. Okay. I don't know if you've got any questions on VAT. Any questions? And the other thing, you can be given an amount which is inclusive of VAT, exclusive of VAT, and then you just need to know the VAT rate. So I will show you how to compute when the amount is exclusive. When it's inclusive, how do we get the VAT amount? So I'll show you those formulas. Okay, any questions from your end? Any questions? Any questions on VAT? And the other thing on VAT is a practice can voluntarily register after invoicing for 50,000. So one has to just prove that they've invoiced for more than 50,000 by producing invoices and as well as bank statements to show that the customer is paid. And then there's going to be a continuous enterprise. There's going to be business going forward. Okay, and this is not being done to defraud SARS. Okay, if there are no questions, then let's discuss other taxes. So with the other taxes that we have, we've got income tax. Okay, the motive of having a law firm, an accounting firm, any business is to make money. So that is the motive, profit making. So with the motive of profit making, then the government also desires to have a percentage of that profit. Okay, so with the nature of our services, we are not categorized as small businesses, but as professionals. So if it's categorized as professionals, then the practice is to pay tax at the normal income tax rates. So income tax, it's tax on profits, profit or loss. So if the entity makes or a practice makes a loss, then there's no tax payable, but there's a benefit in that. Then the practice will go and claim that loss in the coming periods. I heard that now they are saying you can only claim 80%, 20 in the next future. So one is to just read around that. So that's income tax. And with income tax, it's the firm has to prepare financial statements. After preparing financial statements, determine what is the income, the expenses, what is the profit. Out of the profit, then they calculate. In this year, the rate is 27%. They calculate 27%, and then they ensure that they get their income tax, which is payable. And how do we pay income tax? Okay, because income tax is prepared over a financial period. We have discussed about the financial period runs for 12 months. And for individuals, the financial period is from March up to February of the following year. That's a 12-month period. For companies, it depends with the year end, which is on the registration certificate. Okay. And for the companies to pay, they pay through what they call provisional tax. So provisional tax is there to pay income tax. So what you do is that you estimate the profit for the first 6 months, or sorry, for the whole year. And then when you estimate for the whole year, you divide by 2, and then in August, which is 6 months from March or 6 months from the beginning of the year, then one is to file a return and pay. Make sure that the last day you have paid. The important thing is to pay. Okay. And also to have computations where your basis for submission. Okay. And the next would be in the last month of the financial period. In that last month, one is to estimate, make sure that they are around in the region of 90%, 95%, and then ensure that they submit and pay. If there's nothing payable because there's a loss anticipated, then you then submit your return and show that there is no taxable income. Okay, but the return has to be submitted. So that is provisional tax. It is there as a way of paying income tax. And they give leeway. They can say after the second payment, you can make a third payment. While least you are in the process of finalizing the financial statements, you are given a year to finalize the financial statements, prepare them, and submit. So like the financial statements for the year ending 28 February 2023, they are due now in this month of February. So if you can check if you've got any incorporated companies or individuals, already they are receiving, not for individuals, for companies, they are already receiving notifications from SARS reminding them to submit their provisional tax and their income tax for the previous year. Okay, for those who wait last minute. And then for individuals, their tax returns, they are given 11 months. They are given 11 months. So from February up to January, make sure that by end of January they've submitted and they've paid. And individuals, I'm talking about practitioners, so practices who are registered for provisional tax, because they've paid provisional tax also in August, they've paid in February, they've also computed and probably paid if they underpaid, or if they overpaid, then they wait until they submit their return and they are given until January to do so. If you do not submit by then SARS would what? Penalize. They are very good at penalizing. And for you to request for waiver or remission, it usually is very difficult. Okay, so we've spoken about VAT, income tax, provisional tax, and the last one that I'm going to cover is going to be pay as you earn, UIF, and SDL. Okay, pay as you earn is tax that is payable on salaried employees. So salaried employees, it's your employees in the firm, including the directors. The firm or the practice has got an obligation in accordance with the fourth schedule of the Income Tax Act to withhold income tax on a monthly basis as the employees are earning. So if the employees are earning on a monthly basis, then withhold on a monthly basis, ensure that you pay over to SARS. If they are earning on a fortnight, withhold the first fortnight, add it with the second fortnight, pay it over to SARS. Okay, so it's an obligation. So if the practice does not do that, ensure that they withhold money for tax, then the practice, if ever audited, then they will pay for the employees. SARS will just compute and say, okay, can you pay? Then they pay. Because remember, you've paid your employee, you can't go back and say, give me 200,000. It's usually very difficult. So you would rather just comply. Okay. And with UIF, SARS is the custodian of the UIF funds. So the moment you register your employees for pay as you earn, automatically they are registered for UIF. And then with UIF, the tax that is payable is 1% from the employee, 1% from the employer, up to the threshold of 17,712, 17712. So anyone who earns above that, then they are kept at a salary of 17,712, 1% or so UIF is payable. And then with the UIF, the employer also has to contribute an equivalent amount as the employee. So which means it becomes also 1% up to the cap of 17,712. So when we are paying over, it should be a double amount, one taken from the employee, one taken from the employer. Okay, that's UIF. And the obligation to file returns for UIF sits with what there is also the Department of Labor. They overall account for UIF and also administer and make sure that then they utilize the funds accordingly. So with they exchange the money with SARS. And from our end, we are supposed to then go, they've got a portal, and their portal is called uFiling. So the individuals, like one of the directors or the practitioner, they go and register in their individual capacity. And once they register in their individual capacity, then they add in the practice using the pay as you earn number. Okay, so for an individual practicing as a sole practitioner or as a sole practice, they remember it's a business, they register for pay as you earn in their sole capacity. It's the same with VAT, they register. So it will be like a Peter Nail attorneys, okay, because it's not in ink, it registers Peter Nail attorneys for pay as you earn, but everything falls under the profile of the individual, the owner. And then the VAT, it's registered Peter Nail VAT, just for that. And then income tax in the hands of the owner. Okay. If it's a company, then everything, because it's a juristic person, it's a person in its own, then they also register under the juristic person. But the thing is the same. It is the same. The concept is the same. It is only on threshold that I have discussed with you that it is different. Okay, so UIF, I've discussed it, and then we've got lastly the SDL. Okay, SDL is what we call Skills Development Fund, and it is administered according to the Income Tax Act. Okay, so there's a section then that stipulates that if a practice or if a business is to have a wage bill or a salaries bill that exceeds 500,000, 500,000 in a tax year, then they have to register for SDL. So this fund is for skills development for the nation, and it can give you back, like if you register for it, register under the correct SETA, then you are able to claim back for your training. If you are training employees, you can get, what do they call them, stipends that you get from there, so that it helps you with easing your wage bill, especially for your trainees. Okay, so that is SDL. SDL is payable over to SARS, and then SARS is the one that then make sure that it distributes to the various SETAs according to the way that the SDL is registered by the business owners. Okay, right. So those are our taxes that we do have. I don't know if you've got any questions. We've got 7 minutes towards 5 o'clock. So I want us to take a break so that we come back at 5, and then we can continue and get into an example. Any questions? I'm going to come out of stop sharing so that I can go back to the platform and see if ever there's anyone who's got any questions. Those ones who want to take a break, you can take a break. This is a long lecture. Okay, so on our chat, I see someone says, I hope this is being recorded. Yeah, yes. This should be, yeah, it's being recorded. It's being recorded. Because for those who are not present, we need them to benefit. So hopefully they will benefit from it. So it's being recorded. Yes. And then this one says, I did not win. I still don't have volume. Oh, sorry. Volume. Is my volume very low? How is it now? I hope it's better. Maybe my volume was very low, but I've increased it. Hence, I was saying you should speak up, because when I'm on sharing, I'm not able to see the questions. And then it's possibly your internet connection, or someone was answering. I logged out and in. I restart the computer, but dololo. Okay, guys, I hope you can hear me. If you don't answer me, I assume you are hearing me. Please share the video if recorded. I can't hear anything. I don't know what's wrong. Okay, yeah, definitely will share. We'll definitely share. Sorry, Lawrence, for that. Sorry for that. So I hope everyone can hear me, and we can take our break, and then we'll be back after 5, slightly after 5 in the Hello. Welcome back. I think there's someone who's playing music. If you can be able to mute. I can't see someone who's not muted, but I can hear some music. Okay, thank you very much for muting for us. Thank you. I am back. And oh, they say it was Lawrence. Okay, thank you so much, Lawrence, for muting. Or did you, Lawrence? Thank you so much for muting, because I am failing to control you. I didn't want to make sure that I put option for muting you guys off, because if you've got any questions, I want you to ask. And then I've got a question from Elise, where she says, I've got a question relevant to RAF attorneys VAT, which I would like clarity regarding expert invoices paid in on behalf of clients. Would that be covered here, or when you online again, when you're online again? No, yeah, we will cover that. Any question that you have, I'll cover any question that you might be having. So when it comes to experts, the VAT with SARS, the way that they treat, I've attended one presentation from SARS, where they say if you claim VAT from your experts, then they expect you, when you get the disbursements fee, the party costs from the road extent fund, then you also have to tax the amount that you receive for that particular expert. Okay, so say for instance, a doctor, you are claiming for a doctor 20,000 plus VAT, which is 23,000, and you will have to pay the doctor on behalf of a client that 20 plus 3, then in your output you should have 23. In your input you should have 23. What is the effect? 0. So you'll have a 0. Or the second method would be for you, for all recoveries for disbursements, you do not claim. For anything that you do on behalf of a client, because it's not to do with the business, you do not claim any input VAT. So what is the effect? Then it becomes 0. Okay, so it's 2 methods that you use. So if you decide to claim from your experts, then it means, you know, fees on top, you include disbursements as part of your fees. Okay, because you are not separating them from business income and expenses. Okay, I hope you are answered, Louise. Is that okay? And the next one, other question do I have? I had someone who was raising their hand. Pumla, do you still have something to say?
Yes.
Yes.
Hi, can you hear me?
Yes, I can hear you.
Okay. My laptop switched off for a moment there, so I'm not so sure if there was this question that was answered or which was asked about our assignments, the
Okay.
ones that we've already submitted. Are we going to get them returned to us just to see how they were marked, etc., or not?
The assignments were returned. They were returned back to you guys. And I've also posted the model answer, the solution on the platform. So didn't you get your assignment back?
No, maybe I don't know how to get it back. Should I go back to assignments and then check from the grade mark or something?
Not from the grade mark. So when you log in, you go back to the assignment. You go back to the assignment, okay. And then when you click on the assignment, you should, if you check underneath, I don't know how the student platform looks like. If you check underneath, you will see there's an attachment of your same assignment which was marked with tick marks. But I also want to just get into the assignments and check yours. It's Pumlavu.
Yes, Pumla Sibia.
Severe, okay. Yeah. Yeah, they were
Pumla,
marked.
sorry, Pumla, if you are registered with your email address, a link was sent to us with our marked assignments
Mm,
on
Okay, so
email.
this link. Okay,
yeah. On
All right,
email,
thank you
yes.
so much.
Yes, I made sure also they were sent by email, but it's there. It is there. It was returned back to you on the 7th.
Okay,
Yes, so you just need to
Thank you,
log
thank
in
you so
and
much.
check. Yeah. If you can't see it, please get hold of Grace so that she can show you how to navigate. Okay,
Thank you. Thank you so much.
all right, thank you so much. You may mute for me, then we can continue. Another question, or we can continue with our example so that you get more info. Okay, let's continue with our worksheet. And I've posted online, I have posted for you guys the what do you call it? I have posted the question. I hope you were able to see the question for the one that we're going to discuss now. For webinar 2 and webinar 3. Okay, so I'm going to share that question for our webinar. And after sharing the question, I'm going to create a worksheet where we will be working from. So we just want to make sure that we cover as much that you find it easy. Assignment 2 is quite daunting, it's hard. So I encourage you to start earlier. If you can start early, make sure you start early. So this is our question that I posted online. You see this one for webinar 2 and 3. This is the question that I posted. So it is the one that we want to discuss. So I'm just going to, well, at least probably those who have not seen it, you can more of like for now read it. While at least I am opening a workbook that we will work on. I'm going to set up a workbook that we are going to work on. Okay. So we are working on webinar 2 and 3. So I'll call it webinar 2 and 3 for us. You have, I hope you have managed to download the question. It will be easier if you can go through on your side, because sometimes when I'm sharing the screens, they appear so small such that you can't see. And I prefer you guys to see what is happening. I prefer you guys to see what is happening and to ask questions if ever you have any questions. Okay. I'm just preparing us for the worksheets, and then from there we will continue. Okay, so we'll start with our first worksheet. I'm going to share the worksheet for you. Question 2, clear. I'm just clearing amounts that are not necessary. And then the rest I'll do here while we are working on them. Stop sharing. And then All right, share side by side. Okay. Okay, this is our screen. I hope now you can see. It's clear for you to see. I'm going to share side by side like what we were doing so that we are able to read and at the same time we are able to answer. Okay, enlarge it a bit. It's too much like that. Okay, we start with our question. Then it says our firm is a VAT vendor, so we know that we are VAT registered and handles the following transactions for the month of June 2023. Okay, record the following transactions in all necessary cash books and ledgers, T accounts. Consider these transactions to be for one firm which occurred in June. So it's our firm. Do not separate. Why we say that is that most people would go into a particular transaction and then they create a cash book for that particular transaction. Or not transaction, particular matter. Okay. In this case, it's one practice, one trust account, one cash book. Okay, so that's how you should do it. So when you are given matters, everything is being paid into the same cash book. Then you do that. And then we are supposed to balance off the accounts, prepare the trial balances for the business transactions and the trial balance for the trust transactions as at 30 June 2023. Okay, let's be fast. The trust account had an opening balance of 208,000 made up of balances of 100,000 for Mr. Jaden, 108 for Miss Magda. Okay. So we've got an opening balance. So now I assume that you can record your trust meters, your cash book transactions, your business transactions when it comes to the cash books. So if it's an opening balance, it's always on the first day of the month. 2023, so it's our opening balance. How much is it? 208,000, which is this one. I'm here. This is where I am. Okay, and then with the 208,000, then we have to do our double entry. We are told that 100,000 is for Mr. Jaden, so I'll come here, and then this is Mr. Jaden. So we have, this is our receipt. And then on the side of our trust creditors, these are our trust creditors. Then we record the corresponding credit entry, which is also an opening balance. So which means it's coming from the previous period, 100,000 like that. And then Mr. Jaden, and then 108 is for Mrs. Magda. So we come here. Then it's Mrs. Magda. Like that, and it's also an opening balance, and it's so it can be called an opening balance or a balance brought forward. So if you can check, we are balancing 100 plus 108 is 208, and then A, it says we're not going to look at sequence of dates, we're just going to consider posting because the system that we are using here cannot help us with that, but we just want to be able to master the concept. We attended to the file of Mr. Jaden and raised an invoice on 15 June 2023 of 23,000, including VAT. We transferred our fees on 29 June 2023. So if you can have a look at it, it's a transaction that is having how many? One which occurred on the 15th, which was it didn't have any cash movement. There's no cash movement. And then the other one occurred on the 29th of June. That one had a cash movement. So in our cash books, then we can post, but let's consider the ones that do not have the cash movement. So I'm going to do our workings Okay, so we are raising an invoice. So we need to determine which account are we going to debit, account are we going to credit, so that when we post to our books, then it is easier for us. So when we are raising an invoice, our debit, we are creating an asset. Mr. Jaden is our client. It's a Meta, so it's a Meta account or a data account, which is Mr. Jaden. And the amount should include VAT, because this is what we are going to claim from him. So it is going to be fees plus VAT. What we are going to claim from him in full. So it will be fees plus VAT. So here, I'm just going to put like a description, but it's not necessary when we're doing journal entries. Description. Okay, this one's try to. Okay, so our description to our client is going to be our fees plus VAT. So we are told this amount includes, so it has got VAT, so it's 25,000, like that. Okay. And the next one, the double entry, it's going to go to our fees. So what is going to be our fees? Fees will only be the 100%. The 100%, and our VAT would be the other 15% to make it fees plus VAT. So 25 is fees plus VAT, which is equals to 25,000 multiplied by 100 divided by fees plus VAT, which is 115, like that. So this is our answer. So the other way would be 25,000 multiplied by 1 divided by 1.15. Okay. But the easier one that I will teach you would be to say 25,000 multiplied by, we want to determine the 100 out of the 100 plus 15. 100 plus 15, which is 25. So our 100 is 21,739. Okay. Okay, I will leave. This is a working. And then, okay, this one, I'm just going to align to that side. The VAT, so it's going to be 25,000 multiplied by 15 divided by 100 plus 15. You see, because 25 is 100 plus 15, but we just want to determine the 15. Okay, this is how we determine it. So if you can add up this, will give us 25,000. So if I can add it up, we'll get 25,000, and this side will get 25,000. So this is how you split the VAT. This is how you compute your VAT, your fees. So which means we are going to debit Mr. Jaden with fees plus, so it's our Meta. Okay, Meta ledger. Where is it? In our business cash book. Underneath, we've got the general ledger, which is this one, for all our accounts. And then we have got the cash book, general ledger. Okay, let me check. I think the side we've got our business ledger or our Meta ledger, business data, or according to our study guide, it says Meta. So it's our metas that we are accounting for. So in this case, our Meta is for Mr. Jaden. Okay, so with Mr. Jaden, we are going to debit. So our workings say debit Mr. Jaden fees plus VAT of 25,000. So on 15 June 2023, so we are raising an invoice for fee plus VAT. Fees plus VAT, how much is it according to our journal entry, which is 25,000, like that. This is how we raise our journal. This is the debit entry. So we need to do the credit entry according to our journal entries. So where do we get them? We get it into our general ledger. This is our general ledger. So I'm going to delete everything that is in our general ledger. So our general ledger consists of our general accounts, including the assets, liabilities, fees, expenses. So to come up with that equation of ours, so this is where we record our general transactions in our general ledger. So of course I've got cash book, so it's cash book and general ledger, it is all together. They're all in the same, recorded the same. But what I can do is that I can separate. This is our cash book. I can separate and add in and say this is our general ledger, so that we have distinction. When we are posting, we'll be moving between. So I'm going to cut and remove the general ledger and show it here that we've got a general ledger. So we'll start with the fees. Try to enlarge it. So let's start with the fee account, fees account. Okay, and then we record our date, which is the 15th of August. Is it August, June 2023, and our description. Remember, it's coming from our meta with Mr. Jaden. And how much is it? 25,000 multiplied by 100 divided by 100 plus 15. That. So this is our fee account. And then the next one would be our VAT account. So VAT account, this is what it becomes our more of like control account for SARS. This is our control account for SARS. And okay, like that. So also we'll show the dates that we are recording, and it's for the matter of Mr. JD. This is where we are getting the VAT, and it's 25 multiplied by 15 divided by 100 plus 15. Okay, so we have recorded our double entry. These ones, they give us 25,000, and in our meta ledger we have 25,000. So we are balancing. Okay, and then we are told that on 29 June 2023, we transferred our fee. So when we are transferring our fee, we go back to our trust cash book. So you can do a fee journal. You can do a fee journal. Remember, with a fee journal, it's 4-sided. Okay, I might have to be a little bit faster. So our fee journal, we are transferring our fee. The first one is to do with the trust account. So we'll debit our ledger, trust ledger. So this is the trust side, but this is the cash thing, trust side. So we'll debit our client, which is Mr. Jaden. I'm going to call it T, which is the trust account. And how much are we debiting? Our fees, because we are collecting, even for SARS, we are collecting on their behalf, because our duty is to collect on their behalf. So we'll collect the fees as is in full. And then we are going to credit the trust cash book or the trust bank account. How much? The same fee plus VAT, how much? 25,000. Okay, and the business side, we are now receiving that money. Then we are going to receive it in the business account, business bank account. How much are we receiving in full? Our fees plus the VAT, how much? 25,000. And our client, we are showing him that we've collected in full, like that, the fees plus business, and the duties for us then to pay it over to SARS. So let's record it in our T accounts. Okay, this is our business cash book. I'm going to leave one line for the opening balance. Our transactions won't be in sequence, but we are interested in what mastering the concept. So we are receiving the fees for Mr. Jaden. So it's a trust transfer fee plus VAT, which is 25,000. Okay. And when we go to the meta ledger, which is this one, we have received this money on 29 July from our trust account. As we have posted the bank, obviously bank account here, it would be our business. And what is the amount? 25,000 that we have collected. So it would mean this account is closed, cleared, collected. Our invoice we've collected for it. And then on the trust side, I was supposed to start with the trust side, but it is the same. I started with the second journal. We are paying out of our trust account for the matter of Mr. Jaden, and it's a trust transfer fees plus VAT. Fees plus VAT. I've shown you the journal, 25,000. And when we go to our client, the trust creditor, this is Mr. Jaden, we started with 100,000. Then out of 100,000, we've already raised our fee, and we've collected on 29 June 2023. So it's our fees transfer. That how much? 25,000. Okay, so this is how we record part B. So ensure that you do the 4 legs of of part A. And then part B, we briefed Advocate Majiba on the matter of Miss Magda, and he rendered us a bill of 7,500, which we paid on 24 June 2023. These are trust transactions. Okay, trust transactions. So we've got money for Miss Magda. So if we've got money, what do? We pay out of trust. So we then go to our trust cash book. We are paying the advocate when 24 June. So the advocate, because he gave us this particular bill, and we've got money, what do? We pay. It's Miss Magda. And we show that we are paying on behalf of, we are paying on to Advocate Majiba or Madiba, I don't know. And how much? 7,500, like that. So we are paying. Remember our cash books, we've explained this concept. Everyone understands it. And I'll be happy to see you guys performing very well on the cash books, because now you understand them. We've done a lot on the cash books. And to do the double entry, this is our cash book. Then let's do our double entry. Our double entry, we go to the ledger of Miss Magda. This is when 24 June 2023. And then this is the bank account, and we are paying to Advocate. So you give as much detail as possible, so that if ever you want to be audited or to trace transactions, you are able to trace transactions. Okay, 30 June, we've got bank charges of 98 Rand, interest of 405. Bank makes, the bank will make a transfer to the fund on 1 July. Okay, so we are recording for June, so that transaction will miss us because we are not doing July, we'll miss it. Okay, so the interest, it's what? In the trust account. It's in the trust account. Please, you can see it's a written trust account. So make sure you record smartly and according to instruction. Do not overthink these things. Okay, 405. And So we've done a debit entry because it's a receipt. Then we go to the legal practice fund. This is for our trust account. Okay. This is for our trust account. So it is on the 30th of June, 2023. And then we've got interest. This is trust. And then how much? 405. And here we are doing the double entry, and we can show that it's our section 862 account for the fund. Okay, so the fund becomes our creditor because we are supposed to pay the net to the fund. We are paying the net to the fund. And then they say there are bank charges. The bank withheld money for their charges. So we have to account for that. How do we account? It's money paid out into the bank's account. But the thing is that we recover it out of interest. So before we can pay the fund, then we show the net effect of that transaction. So this bank charges for the trust, you should put them on business bank charges, which is an expense of the business. Okay, like that. So that this is how we post. So normally with this one, we have not put in an element. So usually the VAT, the fund refuses to pay the VAT. They say the practice should claim that VAT from SARS, and then the fund will claim that money from the business account of the fund. So normally then the bank will recover from the business account the VAT component, and to the fund usually what is payable, it is they pay the bank charges, net of bank charges, the net of VAT. The bank charges will be having net of VAT. So in this, our example, it's not given, but in your question, it might be there. So you should take note. So if they are recovering money from the business account, it means the business is paying into trust. So I expect to see a payment from business and then received into trust, posted against the legal practice fund account. If we do not have the legal practice fund account, then it just becomes generally a bank charge, part of the bank charges in the business side, because we cannot claim it against SARS if we are not VAT registered. Okay, so those are our trust transactions. And then we've got business transactions. So I want to push so that we cover the business transactions and then we finish. And then when we come back, we'll do the conveyancing matter, we'll do the collection matter, we'll do, and then those two will cover our webinar for the next webinar. And we touch on any other things, questions that you might have, because that will be our last webinar. So let's do the business side of things with the 20 minutes that is left. We are told on 1 June, opening balance was 20,500, 1 June. So if we are not given whether it's a debit or credit, usually banks are supposed to have, our accounts are supposed to have positive balances. Okay, how much is it? 20,500. Okay, like that. And okay, if you can excuse me for 2 seconds, I just want to open my door. It's becoming too warm. Thank you very much. It's becoming too warm and I'm suffocating. Okay, and then let's proceed. We are told that the capital account had 70,500. So the capital account is an account which is created when the owner of the business contributes to the business. When someone is starting a business, there's nothing, there are no resources, there's nothing. So what we find is that the owner would contribute something and then we post that into the capital account. Okay, so in this case, It is money which came into our bank account. We debited the bank and then we credited the capital account. So on 1 June 2023, we had that balance being brought forward and it's 70,500. Okay. And we've got furniture of 15,000. Okay. Furniture of 15,000. Office equipment of 25,000. Motor vehicles of 95,000. MFC loan 85,000. So I'll start with the loans. I'm going to record MFC loan. And MFC loan money came into, okay, we got an asset which we debited, and then the loan, then we credit the loan. Okay, so 1 June, we've got a balance which is coming out of that. It's a liability, it's a creditor of the firm, then we record it. So it's an opening balance. How much is it? 85,000. I hope you can see. I know if I can enlarge, make it too big, you won't be able to see, but let's push it a bit. Okay, like that. And so I started with the loan and then we go to our assets. Let's go to the assets, opening balances for assets. So we are told we've got furniture and fittings. So the furniture and fittings, we will always carry them over until, say for instance, we read them, we see that this is not worth it to continue carrying, then we would write it off. Or if we see the value is too small, we have to revalue. We can revalue and increase the value against the revaluation account. Okay, 2023. So it is the opening balance. This is the cost. I assume this is the cost, but this is the information that we are given. Office equipment. Sorry, for the furniture, it's an asset. Sorry, I'm supposed to post it on the debit side. It's an asset. Assets have debit balances. So it's an opening balance. And how much is it? 15,000. Okay, and then we come to, so this is our furniture. Okay, and then the next one would be our, I'm going to delete this one. I think it's coming from the previous example. So the next one is going to be our office equipment. So office equipment, we are looking at our printers, our scanners, our shredders. So that's our office printers opening balance. And how much are we having? 25,000. Like that. And then we've got also motor vehicles. Okay, so I'm going to create another asset account. Because now we are getting into equity before I can have enough asset accounts. So we've got motor vehicles as well. So motor vehicles. And motor vehicles, it's an opening balance. How much is it? 95,000. So I don't know. It can be one motor vehicle that we do have. Okay, so we've recorded the 1 June, the opening balances. We've recorded everything, the assets. We've recorded the loans. The capital account is the VAT. We've always had it. Okay, and then we are told on 1 June, the following debit orders are paid. So they are paying from our business account and then it goes through to our business cash book. Okay, let me try to minimize so that it can be clearer. You can see, yeah, like that. I know the side when we pull it will be slightly out, but yeah, like that. So the date is 1 June. Now we are paying. So it's easy. Payment side, you pay. How much are we paying and what for? We are paying for rent. When we are paying, we pay in full, 5,700. We do not say, this is rent, this is what we don't pay in full. So we come to our general ledger, we create a rental account. Let me just delete these things. So it's our expenses. Because if the landlord is taking a rental amount by debit, then it means he's collecting all his money. We don't have an account with him because he wants to make sure we do not have an account with him. Okay, so it's the bank account, how much? So it's 5,700 inclusive of VAT. But to our rent account, what we take, remember, the VAT component, we have to claim it from SARS. So we'll claim it against the VAT account. Okay, so here we are going to take the 100 out of the 115. So 5,700 multiplied by 100 divided by 115. Like that. This is our rental. And then when we go, the other second leg would be sitting in our VAT account. This is 1 June 2023. So it's for the rent. How much is it? 5,700. The 15 multiplied by 15 divided by 115, because 5,700 it's the 115. So we only want 15. This is the 15. 855 for car insurance inclusive of VAT. So it's a payment. We go, we record our payment 1 June 2023. It's a car insurance. So just to say car insurance, don't then say you post it under vehicles. It's an expense, a monthly expense that we have. We have to pay until we cancel the insurance or until, you know, something happens, we claim. Okay, and then out of the insurance, I will start by creating the ledger. So it's an expense of the business. So you don't have to have a car insurance ledger. You can combine all your insurances. Sorry, we had load shedding. So sorry for that. So this is insurance, a business expense. 1 June from the bank. How much is it? 855 multiplied by 100 divided by 115, like that. And when we go to our VAT account, here we go. I'm going to enlarge our VAT account a bit, and it's 1 June 2023, and it's our car insurance, which is the 15%, 15 divided by 115, like that. That's what we are collecting. And we've got cell C for internet. We've got 513 including VAT. So we start by making sure the bank is collected. We complete that part. So it's internet services, and then it's cell C. And how much is it? We paid 513, and then we go to our general ledger, to our expenses. We create, so you can create under telephone and insurance, or you can create insurance expenses. Whichever way you do it, we give a mark, but of late we just call it telephone and internet expenses. So telephone and internet, it used to be telephone and fax. So now that the faxes were taken out of business, then we are now taking it as internet. We are now dealing with emails for the businesses to communicate. So this is it. And then we also should always remember the VAT. Every transaction you ensure, for you to balance, you should ensure that you are recording in full. Okay, like that. And then 5,000 debited by MFC Bank for the vehicle loan. Okay, so MFC has taken their money. for the loan. 2023 MFC, how much? 5,000 MFC loans. And if we go to our general ledger, remember we had an opening balance for MFC. Yeah. So on 1 June, they then took a repayment. So this is a repayment. How much is it? 5,000. So it was 85. They took 5. We are left with 80. Okay. Happiness. And we are told 30 June 2023, we paid the messenger, the secretary, their salaries. I hope you have this question. Paid the messenger, secretary, their salaries. The messenger's salary is 3,000 and that of the secretary is 5,000. We deduct 1% UIF, also contribute 1% UIF. I've explained this part. 29 June 2023, attend drew an amount of 10,000. So, and then UIF is payable by the 7th of the following month. And then E, we've got bank charges of 298 inclusive of VAT. Okay, so this is 30 June. So let's start with the 29 June one where the attorney drew his money. 29 June. So we've got drawings. How much? 10,000. So with drawings, it's part of equity. So our equity is our capital account and our drawings account. So I'm going to take this and then I'm going to create our drawings account. And then when we are drawing, because here you can see it's a payment, it went to the credit side. So our drawing will go to the debit side. It's reducing our resources. It's reducing the capital, it's reducing the equity of the business because it's being taken back by the owner of the business. Okay, bank account. How much is it? 10,000. So it's drawings. And then I'm also going to do this one of bank charges. The last one will be the payroll. Bank charges 298 inclusive of VAT. So when you come to our business account, it's a payment. 30 June, the bank has taken its charges for handling our transactions. How much is it? 298. Remember, payments are made in whole and in full. Okay, general ledger, we also come under our expenses. We create that expense account. Let's create that expense account called bank charges. And it is on the 30th last day of the month. And then it's through our account. How much goes to our bank charges? Because the 15 will claim from SARS. Okay, 259. And then the 15 will collect from SARS. So it's only financial services that you do not claim VAT. Financial services, but like interest does not have VAT. But when it comes to bank charges, even on the bank statement, the bank will note it for you to say there is VAT of so much in these bank charges. So if you compute backwards, you'll be able to see, okay, banks are charging VAT. Okay, so this is the double entry. So we are done with everything else except for this transaction. So if we can finish off this transaction, then we can call it a day. It was a long lecture. So I'm going to do payroll. Comes from journal entries. It's a subsidiary account. It's a subsidiary ledger. We do its prime entries on their own through the payroll. So the payroll, how it is recorded, we should have our pay as you earn, our SDL, our SDL comes later, our UIF, and then we should have our gross amount, our pay as you earn, our UIF, our net amount, so that we determine this is how our pay slips are structured, our payroll is structured, and what to post where we determine it from here. Okay, And then we take the employees, so we've got the messenger. What is their gross amount? 3,000. What is the pay as you earn? They're below threshold. What is their UIF? 1% multiplied by 1%. What is their net amount? Gross minus pay as you earn minus UIF. We get what they get paid. So this is what they get paid. This messenger, that what the messenger will get paid. Okay, we do the same for the secretary. It's what 5,000. It's below threshold. No pay as you earn. UIF 1% net. So we're going to copy the formula. Okay, so these are our total of salaries. Okay, our salary, our pay as you earn, our UIF, just like that. Okay, so we are told that with UIF, we've got UIF employer contribution. How much is it? 1%. So it's 1% from messenger, 1% from secretary, which is that. Okay, so to SARS, what is it that we're going to pay, or to UIF? We're going to pay the total of pay as you earn and UIF, which is what? So I'm going to write SARS here. How much are we paying? So this totals here. So here it's 0. And then the total of UIF. And then we add them up together. This is what we are paying over to SARS. And SARS will pay the Department of Labor. So this is our final answer. Our final answer, 160 payable to SARS. Okay. So let's do the journal entries. Let's do the journal entries. So when it comes to the salaries account, it's an expense account. So we debit it with the gross amounts. Okay, general ledger. Create our salaries account under expenses. Okay. Under expenses, we've got our salaries account. Okay, and then from the payroll, we've got messenger. What is the gross amount? 3,000. So we are posting the gross amounts into our, so that is the expense of the company. The deduction is not an expense of this company, so it's reducing. So this is our salaries control account, salaries and wages. So we normally call it salaries and wages account, just like that, salaries and wages account. Okay, so if we post the full 3,000, are we going to balance? I've done the debit entry. So this is the debit entry. So we are going to debit salaries. How much is it? So this is the debit column. This is the credit column. We copy them for ease of showing. Salaries, we're going to debit it with 8,000. So I show individual transactions. And then we're going to credit. We are going to credit the bank. How much are we crediting the bank with? The bank, we are crediting it with these two amounts, what we are paying, the net amounts. Okay. And the net amounts, so which means we are crediting the bank, our business bank, with the net amounts. It's pays on 30 June 2023, and it's for our secretary. How much is it? 5,000 less 1% of 5,000, which is 5,000 multiplied by 0.99. Okay, I'm just doing a shortcut here. But if we go back to our workings, here it is 4950. 4950 like that. Okay, let's move on. Let's do Just need to be quick so that I can finish for you. And then the next one is our messenger. How much are we paying him? It's 3,000 multiplied by 0.99 because the 1% we are paying UIF. Okay, so but our journal entry is not balancing. It's not balancing. It has got a balance like here. If you can say this minus that, you find there's an 80 Rand difference. The 80 Rands difference, where is it going? It is going to our pay as you earn and UIF liability account. Like that, 80 Rand. Okay, so our journal entry is now balancing, which means on our business ledger, this is our business data, our data's ledger. So it's not a business ledger, data's. So on our general ledger, when we go to the general ledger, as part of our liabilities, we've got a pay as you earn. So I'm going to kind of like put it on the same side as the UIF, the VAT, so that we show our liabilities together. But this one, we call it pay as you earn and UIF liability account. Liability account. Okay, so I'm gonna delete everything that is there. So we have done here. It shows that it's going to the credit side. So how much is the messenger? 30 Rand, secretary 50 Rand. Contributions. These are their contributions, general ledger. So 30 June 2023. So we've got our secretary contribution 50 Rand, our messenger contribution 30 Rand to make it 80. Okay, so that is the contribution of the employees. But remember, the company has to also contribute this part, the 80 Rands. So we are going to create a UIF expense account. This is the expense account. So this is for the employer. It's an expense. And then the contribution that the liability part falls to pay as you earn and UIF liability, because we pay it as a gross amount. How much is it? 80 Rand. So our only left transaction is this one. So we go to our general ledger. And then under here, so we are going to credit. Remember, we said we are crediting. So the employer contribution for the month of June would be what? 80 Rands, like that. So if we had pay as you earn, we are also going to post it in this account. But because our employees are below threshold, then we are recording without pay as you earn. Okay. The last transaction that we have, it's UIF expense account. It's the employer contribution. So it's an employer expense. Okay, so I'll just delete. So, okay, I can just then say it's 30 Rand and 50 Rand. Okay, just like that. So that we show who's contributing. So we've done the double entry. So next, when we come, we'll come and balance off. After recording everything, we balance off, and then we prepare our trial balance. That is, we do it in our next webinar. These are our workings. These are, currently we have one data. We will have other data from the other matters that we are going to record. Trust ledger. We have recorded. Okay, the trust ledger, I've recorded underneath. Yes, the ledger. I didn't utilize the side ledger, so I've got the cash book and the ledger. So maybe what I should do, let me cut it and move it to so that it ties up with the descriptions with the tab. So with you can utilize, you can use this method, or you can decide to put them in one long spreadsheet, but you'll be busy scrolling up and down, up and down, up and down, and like what I'm doing. So once I'm done, I will show you how to then I will show you how to format for printing all your ledgers into one document. I'll show you how to format. Okay, so we have our trust cash book, business cash book, general ledger. So trust ledgers, usually they should go closer to, the trust cash book, because we should not mix, remember. We should not mix our books like that. They form one book, which is our trust side. And then the business side has got the business, has got the debtors, and then the general ledger. I just want to make the debtors, and then the general ledger, and then we've got the workings. If we had creditors, then we would also have our creditors. So this is more of like our journal entries, just the workings. We do not get marks for that, but it is crucial for you to understand, just for your basic understanding. Okay, I've taken your time. Those who want to leave, you can leave. I'm going to stop sharing. If you have any questions that you have, please feel free. If you want to leave, you can leave. Thank you so much for your time. We will meet again in webinar 3. Any questions that you might have, any improvements, anything, any comment, you can let me know, so that when I do webinar 3, I'm informed. Thank you very much for your time. If there are no questions, if you are happy, happiness up to now. Okay, do I have anything on the chat? Yeah. Okay, nothing. Thank you, Manga. Thank you, everyone. And yes, Elise.
Thank you. That was informative.
Oh, thank you so much. Thank you so much. We will, Grace will post it on the website for those who could not make it because of load shedding and other issues. She will post. So I'm going to stop recording, and from now on,